Most people believe the global banking system is safer than it was in 2008. Stronger regulations, stress tests, capital requirements. On paper, everything looks stable. But history doesn't repeat itself the same way. It evolves. And today, the biggest risks inside major banks aren't where most people are looking. This isn't about panic. This is about patterns. Because every financial crisis shares one common feature. By the time the public notices the danger, it's already too late. Lehman Brothers didn't collapse overnight. It eroded quietly, quarter by quarter, hidden behind complex balance sheets, accounting assumptions, and misplaced confidence. And if you know where to look today, the warning signs are familiar. Let's start with the uncomfortable truth. Big banks don't fail because of one bad decision. They fail because multiple small risks line up at the same time. Right now, 3 of those risks are quietly building pressure beneath the surface. Risk. Number 1. Unrealized losses that don't look like losses. Since 2022, interest rates have risen at the fastest pace in modern history. That sounds like a headline you've already heard. But here's what most people miss. When rates rise, the value of existing bonds falls, and banks hold trillions of dollars in long-term government and mortgage bonds purchased when rates were near zero. Those losses don't always show up on income statements. They're often labeled as held to maturity, which is accounting language for we won't admit the loss unless we're forced to sell. On paper, that looks fine. In reality, it creates fragility, because if depositors demand cash or funding tightens, those bonds must be sold at a loss. That's exactly what triggered the 2023 banking failures. And here's the part that should make you pause. The problem didn't disappear. It was simply backstopped. Unrealized losses didn't vanish. They were frozen in place, which means banks are still vulnerable to liquidity shocks. Not insolvency, liquidity. And liquidity crises move faster than regulators can respond. Risk number 2. Commercial real estate isn't localized. For years, commercial real estate was treated as a separate problem. Office buildings are struggling, but it won't affect big banks. That narrative is becoming increasingly fragile. Office vacancy rates in major US, UK, and Australian cities remain elevated. Refinancing costs have exploded, and property values are adjusting downward. Slowly, then suddenly. Many loans issued between 2017 and 2021 were priced for a world that no longer exists. Low rates, high occupancy, stable demand. Now banks face a dilemma. Extend loans and pretend values haven't fallen, or force write-downs and expose capital weakness. Neither option is painless. And unlike residential mortgages, commercial loans are often short-term and variable rate. That means risk doesn't roll in gradually. It hits at refinancing deadlines, quietly, deal by deal, balance sheet by balance sheet. This isn't a crash story. It's a slow compression. Risk number 3. Confidence is the most fragile asset. Banks don't run on cash. They run on trust. The moment that trust weakens, even slightly, everything changes. In 2008, confidence collapsed because of toxic assets. In 2023, confidence cracked because of speed. Digital banking has changed everything. Deposits don't leave banks over weeks anymore. They leave in hours. A rumor, a headline, a viral post. That's all it takes. And while central banks can provide liquidity, they can't manufacture confidence. The public assumes large banks are immune. But size doesn't eliminate risk. It concentrates it. When institutions grow large enough, their balance sheets become opaque, even to regulators. And opacity is where crises hide. Here's the key takeaway so far. We are not replaying 2008. We are watching a new type of stress cycle unfold. One driven by interest rate shock, asset repricing liquidity sensitivity, and digital speed fear. No single factor causes collapse, but together, they create conditions where a single unexpected event can tip the system. If financial crises were easy to detect, they wouldn't be crises. They don't announce themselves, they don't ring alarms. They move quietly, inside systems people assume are stable. That's why stress tests exist. But here's the uncomfortable reality. Stress tests don't test the right things. Bank stress tests are designed around known risks, recessions, market crashes, unemployment spikes. What they don't test well is behavior. They assume depositors act slowly. They assume funding markets stay open. They assume correlations remain stable. History shows otherwise. In real crises, correlations break, liquidity vanishes, and behavior becomes nonlinear. One bank problem quickly becomes everyone's problem. Stress tests ask, can the bank survive? Markets ask, do I trust this bank tomorrow morning? Those are very different questions, and confidence moves faster than capital ratios. Why big banks are harder to read than ever. Another reason risk stays hidden is complexity. Modern bank balance sheets are not transparent. Derivatives, off-balance sheet exposures, cross-border funding arrangements, counterparty dependencies. Even experienced analysts struggle to model the full picture. And when banks hedge risk, they often hedge it with each other. That creates a web, which means one failure doesn't stay isolated. Lehman wasn't dangerous because it was small. It was dangerous because it was connected. Today's banks are more connected than ever. The system is resilient, until it isn't. The silent indicator. Most people ignore. There's one signal that appears before nearly every banking crisis. It's not stock prices. It's not earnings. It's not headlines. It's funding stress. When banks begin paying more for short-term funding than their peers, when interbank trust quietly erodes, when liquidity facilities get used just in case, that's when cracks form. These signals rarely make front-page news. But they show up in money markets first. By the time equities react, the damage is already done. Is this the next Lehman moment? That's the wrong question. The right question is, are we building conditions where a Lehman-style shock could happen again, just from a different direction? The answer is yes. Not because banks are reckless, but because the environment is unforgiving. Higher rates expose past decisions, slower growth reduces margin for error, and digital speed amplifies fear. The system doesn't need a villain. It just needs pressure. And pressure is building unevenly. Some banks will adapt, some will merge, some will quietly be rescued, and one or more will become a lesson, not a repeat, a reminder. What this means for you. This isn't about telling you to panic. It's about awareness. Understanding that banking stability is not a permanent state. It's a condition that must be constantly maintained. Diversification matters. Liquidity matters. And blind trust is expensive. The smartest investors don't wait for confirmation. They watch structure. They watch incentives. They watch stress before it becomes visible. Every financial era believes it has fixed the last crisis, and every era eventually learns it hasn't. The next Lehman Brothers, if it happens, won't look like Lehman. It will arrive quietly, be explained confidently, and only make sense in hindsight. The question isn't whether risks exist inside big banks. They always do. The question is whether we're paying attention before they matter. If this analysis helped you see the financial system more clearly, like the video, subscribe to the channel, and share it with someone who still believes big banks can't fail. Because understanding risk early isn't fear, it's preparation. And in finance, preparation is everything.